Hello, everyone, and welcome to our finance presentation by Seamus Mitchell, Angus Robertson, and Will Jordan Thomas. After our client inherited £100,000, we have put together a financial portfolio with multiple investment options. We have carefully considered risk, return, liquidity, and tax implications when putting together a portfolio. The ENH concept is a theory in financial economics that states that the prices of assets, such as stocks, bonds, or commodities, reflect all the available information about their value.
So first we'll be looking at bonds. Bonds are essentially a loan that is issued by corporations and governments when they want to raise money. Bonds are a good investment because they offer stability and consistent income, and they tend to be less volatile than stocks. So the four primary categories of bonds are government bonds, municipal bonds, corporate bonds, and agency bonds. Government bonds have been considered one of the most attractive investment portfolio tools due to the fact that they're considered one of the safest investments due to backing the government issue. Next up, we have municipal bonds, which are issued by local governments, regions, and cities to fund public projects. They carry less risk than corporate bonds, but more risk than government bonds because they're not backed by a federal government. Tax exemption has enabled municipal issuers to obtain funds at lower rates than similarly rated corporate bonds. Corporate bonds are debt securities issued by a corporation to raise money. The company gets the capital it requires and gives investors a pre-established number of interest payments. And then there's agency bonds, which is a debt issued by a government or sponsored enterprise or federal agency. In terms of tax, a lot of agency bonds are exempt from local and state taxes, which makes them a good investment. Overall, bonds are a steady income stream to an investment portfolio, which can help reduce the risk associated with the portfolio. And they have an inverse relationship with interest rates, meaning that when interest rates are high, bond prices are low. Next up, we have stocks. Stocks are a small piece of equity in a company where the stock price is generally reflective of the value of the company, but the actual price is determined by what market participants are willing to pay. Stocks are a good investment because they have high potential for returns. The four stocks we'll be looking at are common stock, preferred stock, growth stock, and value stock. Common stock represents partial ownership in a company and enables investors to generate profits, typically paid in dividends, and stockholders can vote on company decisions. Preferred stock is similar. However, it is important to recognize that preferred stock does not come with voting rights like common stock does. However, unlike common stock, if the company dissolves, preferred stock holders get paid first. Growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. These stocks typically do not pay dividends. However, investors instead earn their money through capital gains when they sell their shares in the future. Next up, we have value stock, which is shares of a company that appears to trade at a lower price relative to its fundamentals, such as dividends, earnings, or sales, making it appealing to value investors. Overall, like an evaluation of the stock investment, stocks can increase in value by a significant amount over time, which shows high growth potential. The majority of stocks pay out dividends, which gives the client a passive income for the portfolio, and they're easy to buy and sell, so your money is accessible and brings liquidity to the portfolio.
All right, so next up is cash ISA. A cash ISA, you can deposit up to £20,000 per tax year. New rules in 2024 to 25 now mean you can open as many cash ISAs as you wish, as long as you stay within your annual allowance. Up to £85,000 of your money is protected by the Financial Services Compensation Scheme. You can choose from easy access, fixed rate, variable rates, or even a cash lifetime to save for your first house or retirement. A cash ISA account is a good addition to an investment portfolio because any interest earned is tax-free regardless how much you earn. It's a low-risk investment as it brings stability to the portfolio and balances out any more volatile investments. They are easy access accounts, meaning you can withdraw money at any time, which gives the portfolio more liquidity. Commodities are a natural resource or agriculture product that are grown, mined, or processed and are critical inputs in the production of food, energy, and clothing. The two main types of commodities are soft, which are grown or reared and include coffee, wheat, and soybeans. And the second option is hard commodities, which are mined or extracted, which include gold, silver, oil, and natural gas. Investing in commodities. There are several ways to invest in commodities, including buying physical commodities, investing in future contracts, or investing in commodity-related stocks such as ETFs. Before investing, it's essential to research and analyze the market thoroughly. Different type of commodities are broadly categorized into energy, metal, and agriculture commodities. Direct investment includes physical ownership and future contracts. Future contracts are standardized agreements to buy or sell a specific commodity at a predetermined price and date, whereas indirect investment methods include investing in commodity stocks, exchange-traded funds, or exchange-traded notes.
Moving on to currency, also known as the forex market, which is the foreign exchange. This is a conversion of one currency into another at a specific rate known as the foreign exchange rate. The forex market is made up of banks, investor firms, hedge funds, and investors. Why to invest? The forex market seeks very high and major returns in a short period of time. Due to this, gains can be exponential as transactions can be made and completed very fast. It is very flexible, allowing individuals to trade freely 24 hours, 5 days a week. It's a great investment option to diversify your portfolio in case of a market crash. The implications of this investment is that it's a very high risk investment due to the large volatility and liquidity within the market. Another implication is the knowledge and the complexity of investing in Forex is key when determining markets to seek returns. As well as that, due to the high leverage, it can cause uncertainty. And without a risk management plan, there won't be any returns made back on investment. Moving on to a high interest savings account. This is an account where money can be held that gains interest over a period of time and significantly has a higher rate of interest rather than traditional savings account. Why to invest into a high interest savings account? It is great for enabling low risk but seeking higher returns over a period of time. Thus, they are suitable for hitting targets safely while being a liquid investment, allowing accessibility to withdraw funds whenever. Funds up to £85,000 are protected and regulated by FCA and FCS, regardless if the provider goes bust, ensuring confidence and lack of risk. The risk and implications of this investment is the lack of growth potential, as it due to rising of inflation leading to any returns and gains incurred, providing less value for long time. Another one is taxable due to capital gains tax that can eat away any gains made in the duration since the deposit. Evaluation of this investment is, in terms of growth of investing into a high interest savings account, it is limited to a fixed rate leading to gains made over a period of time. It is extremely safe and low risk due to being financially and legally protected.
So we put together a recommended portfolio where we've basically put 20% into a cash ISA, 20% to government bonds, another 20 into corporate bonds, 10% into growth stock, 15 into Forex, and 15 into high interest savings account. The reasoning behind this is, well, with the cash ISA, any interest earned is tax-free regardless of how much you earn. As it is a low risk investment, it brings stability to the portfolio and balances out any more volatile investments we have. Government bonds, again, they offer an element of safety in the portfolio due to the backing of government issue. Interest earned on these bonds will count towards taxable income. However, government bonds are a highly liquid investment and capital gains made are tax-free. So next up with corporate bonds. Corporate bonds, again, offer an element of safety due to the steady income stream through interest payments. And unlike government bonds, they carry a bit more risk due to not being backed by government issue. But in return, they come with high interest payments. With growth stock, unlike the previous investments, growth stock offers a higher risk, high reward investment. Growth stock is considered more volatile than other stocks and typically does not pay dividends. Instead, investors make their money by selling the stock once it has grown in face value. Though there is a higher risk to this approach, the steady income from other investments in the portfolio decreases the overall risk. Furthermore, growth stock is considered liquid. Next up, Forex. So currency trading helps diversify a portfolio by being a high risk, a high return investment, whilst also being highly liquid. This is a great investment to spread and diversify liquid cash as a safety net that can't be withdrawn and accessible at any time necessary. High interest savings account. So on the other hand, a high interest savings account is a very low risk, which brings stability and confidence. when investing while seeking small gains. Also, by being a liquid investment, gaining accessibility to cash invested is easy and can be used in an emergency.
So now we'll be talking about the tax implications of these investments on our portfolio. So with a cash ISA, no tax is actually paid on any interest earned, so that won't have any implications. For government bonds, interest gained is subject to income tax, capital gains tax on profit through sales. Corporate bonds, income tax on interest charged at your usual tax rate, and capital gains allowance up to £6,000. Growth stock, capital gains tax if you exceed the annual allowance of once again £6,000, and the basic taxpayer pays 10%, whereas the higher rate is charged at 20%. With Forex, capital gains tax after annual allowance when using Forex trading, and for the high interest savings account, tax paid when you exceed your personal savings allowance, which is £1,000 for basic rate and £500 for the higher rate. Implications of the efficient market hypothesis. Our portfolio spreads risk across multiple different investments, which fits within the EMH. If the EMH is in strong form, the best strategy is to diversify the portfolio and reduce risk compared to if you put all the money into one investment. Our passive investments, which include a cash ISA, bonds, and high interest savings account, show trust in the hypothesis as we are earning long-term steady returns. However, as Forex trading is volatile, this may mean we are slightly going against the hypothesis and are hoping to find inefficiency in the market.
To conclude, this investment portfolio has been made to find a balance that manages a split between risk, liquidity, diversification, and short and long-term goals. With investments such as the cash ISA, high interest savings account, and government bonds, it gives a portfolio a nice foundation of low risk and passive income for our client. The addition of corporate bonds and growth stocks brings in slightly more risk, but the potential for high returns compared to the investments previously mentioned. Last but not least, the inclusion of Forex trading brings liquidity and volatility to the portfolio and gives the client a piece of high risk, high return investment. The complete portfolio suggests a belief in the efficient market hypothesis through diversity and passive income through numerous investments. Here's our references that we have used.
Thank you
for listening. Hope you enjoy.